A buddy of mine actually just finished a massive $1 million build last month. The final punch list was totally signed off. I mean, everything's absolutely perfect. He had $80,000 in retainage just sitting there, but he had 90 days until the official release. And, he could not make payroll on month 2 of the wait. It was just brutal to watch.
Yeah, that is incredibly common. The 5 to 10% retainage hold is basically a silent killer. I mean, it destroys subcontractor cash flow entirely. The physical work is completely done. The job simply did not finish paying out.
Right.
It just sits there.
Exactly. If you run AIA contracts, retention is built into every single draw. The final check literally never arrives until a substantial completion fully clears.
Well, that brings us right to our focus today. Welcome to the deep dive, everybody. Today, we are looking at the 2026 engineering and construction industry landscape. We gathered a stack of 6 specific industry intelligence reports for you.
We really want to uncover the hidden financial traps causing these huge business failure rates. We also want to explore how smart operators use new strategies to survive. Because honestly, there is a huge contradiction in this industry right now. The construction sector added $890 billion in value last year, but there is an 80% long-term business failure rate. I mean, how does that make any sense at all?
So the context surrounding the industry right now is absolutely fascinating. The industry is facing cooling overall sentiment across the board. Yet, there is explosive growth in very specific specialized areas.
We really need to see where the money flows first. We have to understand the market before we jump into the financial traps.
Absolutely. So demand has shifted sharply toward artificial intelligence data centers. This specific sector has a 57% net positive outlook right now.
Oh, wow. That is booming.
It really is. United States power demand from data centers will grow 5-fold by 2035. That requires massive new power infrastructure just to support it all.
Meanwhile, traditional retail and private office construction are heavily contracting. I think sentiment is down 18% for the retail space.
Yeah, high vacancies and shifting consumer habits are just crushing those traditional building segments.
But, let us talk about the massive labor crisis. You cannot build complex data centers without qualified people. The industry needs 349,000 net new workers right now.
That is a truly staggering number for any industry, and it gets much worse when you look ahead. By 2031, 41% of the current workforce will retire.
Wait, 41%? That is huge. Wage growth in construction is jumping 8 to 12% right now. The national average is barely touching 4%. The West Coast pays a 25% premium just for regulatory reasons alone.
Yeah, and southern states are struggling heavily with this too. Immigration enforcement affected 1/3 of construction firms recently. Workers are simply failing to appear on job sites.
So can technology simply replace these missing human workers?
Well, this is actually already happening on modern job sites. Firms use agentic AI for autonomous scheduling and coordinating massive workflows.
Wait, what exactly is agentic AI?
It is basically artificial intelligence that can take independent action. It does not just alert you about a schedule conflict. It actually emails the concrete supplier to delay the delivery.
Oh, really?
Yeah, it negotiates the new drop-off time without any human input.
That is wild. I mean, it acts exactly like a project manager.
It really does. Firms are also using digital twins and connected tools. A digital twin is basically a virtual replica of the physical building.
How does a virtual replica help save time exactly?
Well, you can simulate mistakes in the software before pouring actual concrete. Finding a pipe clash digitally takes maybe 5 minutes. Fixing a pipe clash in real concrete takes 2 incredibly expensive weeks. So these tools can reduce overall project timelines by up to 20%.
That is incredible. But, technology and heavy machinery costs serious money. Let us look at the cash flow problem.
Yeah, that brings us straight to the financing side of construction.
Right.
Retainage financing is literally borrowing against money you already earned.
See, I always thought retainage was basically bonus money for job well done.
You are definitely not alone in that thought. But retainage is not profit. It is delayed payroll. Every contractor who treats it as a bonus is making a huge mistake.
Because they run out of cash on month 2 of the next job, right?
Exactly. The work is completely delivered. The invoice actually exists. The project owner agreed to the exact number. The only thing missing is the calendar date.
So lenders advance against retainage exactly because the receivable is real.
Precisely. Let us break down the exact math on this problem. Take a standard $1 million project with an 8% retainage clause. You have $80,000 completely frozen.
That is a quarter of payroll for a 5-person crew.
Exactly. 2 months into the next job, your bank account hits absolute zero. Getting new projects off the ground remains a massive financial hurdle for you.
How do operators survive without proper retainage financing?
Well, they borrow personal money from savings, they float high-interest credit cards, they take merchant cash advances. All three cost significantly more than a standard working capital line.
Material tariffs reached 25 to 30% in 2025. Project abandonment increased by over 88% because of these high costs. So, how are firms handling that?
Firms survive this through strategic stockpiling of essential materials. They buy early to buffer against wild price swings in the market. But, getting started triggers what we call the mobilization gap.
What exactly is the mobilization gap? I hear that term constantly.
This is a 60 to 90-day cash flow void. It occurs between starting actual physical work and receiving the first progress payment.
Upfront costs to start a job are just brutal. You have surety bond premiums taking 1 to 3% instantly. Yellow iron logistics also drain capital right away.
Yeah, you have to pay for transport and fuel before moving any dirt.
Then you hit the 5 to 10% retainage hold. Project owners withhold this cash until the very end of the job. It sounds like opening a massive restaurant. You buy all the expensive groceries today, you pay the chefs, you cook a massive banquet for 100 people, but the customer holds back 10% of the bill for 3 months. They just want to make sure they digest the food okay. Your profit margin is totally trapped, but you still have to buy groceries for tomorrow.
That is a perfect analogy. You are describing the exact pain of the 5 to 10% retainage hold. It really drags you down.
I noticed new lease accounting standards also complicate your survival. I have seen ASU Node 2016-02 mentioned in the reports. What does that actually mean for a contractor?
It completely changes how you report leased equipment. Before this rule, leasing a fleet of trucks was basically an invisible operating expense. It just lived quietly on your income statement.
And what happens under the new rule?
Now those leased trucks sit squarely on your balance sheet. You must report a right-to-use asset. You also must report a corresponding financial liability.
Does that not make your balance sheet look terrible to banks?
Yes, it definitely can. It increases your recorded liabilities. This can heavily impact your overall bonding capacity with sureties.
Because underwriters focus heavily on your ratio of equity to backlog, right?
Exactly. It makes you look buried in debt. Heavy machinery represents another massive capital drain for you. Construction fleets average over 38,000 miles per year.
And the national average for normal vehicles is only 33,000 miles. The wear and tear on these machines is intense. Aging assets over 10 years old costs 35% more to operate.
Right. Repairs and poor fuel efficiency absolutely destroy your tight margins. There is a massive replacement funding gap out there right now. Many organizations simply defer equipment replacement to save cash today.
I saw one audit showed a $21.3 million funding gap. That was for vehicle replacements alone. That deferred maintenance must create a cascading financial burden over time. Why do companies keep old trucks if they cost so much more to run?
Well, it comes down to massive upfront replacement costs. A heavy-duty dump truck costs up to $300,000 now. Most contractors simply do not have that liquid cash available.
Regional factors also drive up equipment costs severely. The reports highlight regional cost spikes. Dallas-Fort Worth excavation rates run up to $425 per hour. Why is it so high there?
It really comes down to expansive clay and caliche soil. Caliche is basically natural concrete hiding right under the top dirt.
So a standard excavator cannot handle it at all.
Not at all. Standard buckets will just shatter their steel teeth on caliche. You have to bring in massive, heavy-duty rock trenchers. Those machines burn insane amounts of expensive fuel.
That destroys your profit margins very quickly. The recommended play for this is the core plus flex strategy.
Yes. You buy your daily core equipment, then you rent specialty tools for very specific project phases. You buy the skid steer you use every single day, you lease a massive crane you only need for 2 weeks.
But you still need significant capital to float those daily operations.
That is why a working capital line is the bridge that does not care which job is paying.
That is a vital distinction to understand. Accounts receivable financing advances against a specific retainage invoice. But a working capital line draws against the health of the business itself.
Exactly. They have a totally different cost structure. But the exact same operational problem gets solved. Operators with a steady pipeline of AIA jobs use the line.
And operators with a single big retainage use accounts receivable financing for that one specific project.
Precisely. The government also provides specific tools to ease these heavy equipment burdens. The One Big Beautiful Bill Act passed in July 2025. It brought back 100% bonus depreciation.
That sounds like a total game changer for contractors.
Oh, it really is. Section 179 lets businesses deduct up to $2.56 million for 2026 equipment purchases. It really encourages you to buy new machines today.
Cost segregation for commercial real estate is also massive.
Yes, it is. Cost segregation is a way to speed up depreciation on a building. Reclassifying building components can increase first-year depreciation by 9 times.
How does that actually work in practice?
Normally, a commercial building depreciates slowly over 27.5 years. That is a very slow tax write-off. Cost segregation brings in an engineer to look closely at all the building components.
What are they looking for exactly?
They separate out things like specialty lighting or dedicated electrical outlets because those smaller components can be classified as 5-year assets. You get to deduct their total cost much faster.
Let me push back on this a little bit. Are these tax codes just unfair loopholes for wealthy contractors? I mean, it sounds like they are just dodging taxes.
I completely understand why it looks that way from the outside. We're just looking at the reports here. But these are very intentional government incentives. They keep construction firms liquid and encourage massive infrastructure growth.
So the government actively wants contractors buying new machines?
Yes, proper tax planning helps offset the pain of the 5 to 10% retainage hold. A dollar saved on taxes today is worth much more than a dollar saved later.
You still need proper paperwork to get the actual capital to survive. What is the standard checklist to get approved for this funding?
There is a strict 5-document checklist. First, you need 3 months of business bank statements. Second, you need your last year tax returns.
That seems pretty standard for any bank loan. What else do you need?
Third is your driver license front and back. Fourth is a voided business check. Fifth is a signed AIA G702 and AIA G703.
Why are those specific AIA forms so incredibly important?
Because they show the exact retainage held by the project owner. It proves the money is real and officially verified.
What usually trips contractors up during this specific application process?
A missing schedule of values is very common. Sometimes the retainage line is not itemized correctly on the actual form, or the project owner has not signed the most recent draw request.
You definitely have to get those clean before you ever apply. Even with tax breaks, firms need immediate cash to bridge the gaps. Traditional bank loans take 4 to 8 full weeks.
They also require a FICO score of 680 or higher. They usually want 2 to 3 full years of clean tax returns.
That is where alternative lenders come in. They use AI to evaluate real-time revenue through open banking.
Right, open banking lets the AI read your real-time cash flow. It does not rely on a 2-year-old tax return. They can fund within 1 to 7 days.
They also accept FICO scores down to 500.
Yes, they do. Alternative financing products include revenue-based financing and invoice factoring.
Taking an alternative loan sort of feels like paying a premium for an emergency room visit. Is the high cost ever truly worth it for a contractor?
You have to measure the true cost of capital versus the cost of inaction. A fast alternative loan can save a highly profitable project from failing. You just need to pass the underwriting reveal.
Let us hear about this 3-filter underwriting reveal. How do lenders actually decide who gets the money?
First is the industry filter. The marketplace matches the contractor to a lender that specifically funds AIA contract receivables. Not all traditional lenders understand complex construction billing.
That makes total sense. What is the second filter?
Second is the credit filter. A FICO score above 650 unlocks accounts receivable financing pricing. A score below 600 routes directly to alternative working capital.
What about the scores falling right in between those numbers?
Falling in between depends entirely on your debt service coverage ratio. This measures your available cash flow against your current debt obligations. It shows if you can actually afford the new payment.
And what is the final filter?
The third filter is loan size. This determines your exact lending track. Track A is $25,000 to $250,000. That is specifically for retainage advances.
Smart firms use a strategic graduation strategy. They start with alternative loans to build a solid payment history. Then they graduate to traditional bank loans when their balance sheet improves.
Exactly. You use the expensive capital to survive today. You transition to cheaper capital tomorrow. Who actually survives the gap? It is the sunshining borrower.
The sunshining borrower is the smart contractor who set up the line before substantial completion. He did not wait for the cash crisis to hit his business.
He drew payroll from the line on day 1 of the wait. The retainage releases 90 days later. He pays the line back in full and starts the cycle on the next job.
That is incredibly smart planning. Let us recap what we learned today. You must actively manage your equipment utilization and project backlog. Accurate backlog management is absolutely critical for your overall bonding capacity.
Understanding current tax codes and alternative lending will help you survive the mobilization gap. These rules are the literal difference between failing and thriving in a global market.
You cannot rely on hope to make your next payroll. The industry is transforming rapidly.
It really is. As AI and autonomous equipment become standard, a very strange thought emerges. Will the most valuable construction worker of the future never actually visit a physical job site?
Now there is something to think about.
If you have retainage frozen behind a punch list, or you cannot start the next job because the last one is not paid out, we can help.
Yeah.
Visit BusinessLoan.Directory. Click Pre-Qualify. Tell the form you need retainage financing. We route you to the lender that advances against AIA contract receivables. It takes 2 minutes, there's no credit pull, and no cost to you.
Right capital at the right time. See you next time on the Deep Dive.